Hello, and welcome to our deep dive into a day in the life of a U.S. investment banker. Over the course of this series, we will pull back the curtain on one of the most demanding, competitive, and often misunderstood professions in the financial world. Our goal is to provide a comprehensive and realistic overview, exploring the culture, the challenges, and the daily tasks that define this career path. Before we begin, it is essential to state a very important disclaimer. This series is for informational and educational purposes only. The content provided is a generalized representation of experiences in the investment banking industry and should not be considered financial, investment, legal, tax, or career advice. The world of finance is complex and regulated, and you should always consult with a qualified professional for any personal financial decisions. The scenarios and characters depicted are illustrative and do not represent any specific individual or firm. Our aim is to educate and inform, not to advise. With that, let's step into the world of a junior investment banker. Our story begins not in a gleaming skyscraper overlooking Wall Street, but in the quiet darkness of a city apartment. The time is 4:30 a.m. For most of the world, this is the middle of the night. For a first-year analyst in a major U.S. financial hub like New York or Chicago, this is the start of the workday. The alarm isn't a gentle melody, it's a signal to get ahead of the world, because in finance, information is currency, and time is the most valuable asset. The first move isn't towards the coffee machine, it's for the smartphone on the nightstand. Switching it off airplane mode, the screen instantly floods with a torrent of notifications, emails, news alerts, and market data from across the globe. This isn't casual morning browsing. This is the first strategic task of the day, absorbing the overnight narrative. What happened in the Asian markets while the US was asleep? How did the European markets open? Was there any unexpected geopolitical news? A surprise earnings announcement from a key company? This information is critical because the global markets are interconnected. A ripple that starts in Hong Kong can become a wave by the time the New York Stock Exchange opens. The analyst's job is to understand these ripples immediately. They are looking for anything that could impact the deals they are working on or the clients they serve. This initial half hour is a silent, focused sprint of information consumption. They are scanning headlines from the Wall Street Journal, the Financial Times, Bloomberg, and Reuters. They are also meticulously reading through internal emails sent overnight from senior bankers, who might have had late-night thoughts or received urgent client requests. An email from a managing director sent at 2 a.m. isn't just a message, it's an immediate priority. By 5 a.m., the analyst is likely at their small desk, not just reading, but beginning to synthesize. One of the most common early morning tasks for a junior banker is to help prepare the morning notes, or a daily market update. This is a concise summary of all the critical overnight news, market movements, and relevant updates for their specific industry group, whether it's technology, healthcare, or energy. This document isn't for them. It's for the senior bankers, the vice presidents, directors, and managing directors, who will walk into the office wanting a high-level briefing to prepare for their day of client calls and strategic meetings. The analyst must be able to distill hours of global activity into a few key bullet points that are sharp, accurate, and insightful. Around 5:45 a.m., it's a race against time for personal prep. A quick shower, throwing on the uniform of the industry, a crisp suit and tie, and maybe, just maybe, grabbing a protein bar or a banana. A leisurely breakfast is a luxury that doesn't exist on most weekdays. Coffee is the fuel, often consumed on the move. The commute, whether by subway, train, or car service, isn't downtime. The phone is back out. This is a chance to catch up on less urgent emails, review the day's calendar, and mentally map out the impending tasks. The city is still waking up, the streets gradually filling with life. But for the investment banker, the day is already 3 hours old, and the mental engine is running at full capacity. Stepping into the office building around 6:30 a.m., there's a unique atmosphere. It's quiet, but it's an electric kind of quiet. The only people in are the most junior analysts and associates, along with a few senior workhorses. This is the calm before the storm. This precious hour before the senior bankers arrive, and the markets open, is crucial for preparation. The analyst heads straight to their desk, a space often adorned with multiple large monitors. Their first task at the office is to finalize and distribute those morning notes they started preparing at home. Then they immediately turn to the core of their workload. Perhaps they were working late into the night on a financial model, a complex spreadsheet that serves as a company's financial X-ray, projecting its future performance. Now is the time to update that model with any new data and double-check every formula. In this world, a tiny error in a spreadsheet can have massive consequences, so attention to detail is not just a skill. It's a survival mechanism. By 7:30 a.m., the senior members of the team begin to arrive. The first meeting of the day is often an internal team huddle. The vice president, or VP, will gather their analysts and associates to set the day's agenda. They'll run through the priority list. Alex, where are we on the pitch book for the Acme Corporation? Sarah, I need you to pull the latest trading comps for our client in the software space. We have a call with them at 10 a.m., so that needs to be ready. This meeting sets the frantic pace for the day. A pitch book is a detailed marketing presentation used to persuade a potential client to hire the bank for a service, like a merger, an acquisition, or an IPO. Trading comps are a form of analysis that compares the current valuation metrics of a company to those of its direct competitors. These tasks require incredible speed and precision. The VP isn't just assigning work, they are orchestrating a complex series of deliverables, all with tight deadlines. As we approach 8 a.m., the analyst's personal to-do list is now a concrete set of high-priority tasks. The information gathering phase of the morning is over. The preparation is complete. The directives from senior leadership have been given. The sun is now fully up, casting long shadows across the city. The office is buzzing with energy and anticipation. The outside world is just starting its day, but for the investment banker, the marathon is already well underway. The foundation for a day of high-stakes decisions, relentless analysis, and immense pressure has been carefully and methodically laid, all before most people have even had their first cup of coffee. This intense, pre-dawn ritual is not just about waking up early. It's a systematic process of gaining an informational edge and preparing the analytical tools that will be wielded throughout the day. It's about setting the stage for the performance to come. Join us in Chapter 2, as the U.S. markets prepare to open, and our analyst dives headfirst into the core of their work, building the pitch books and financial models that drive the world of high finance. Welcome back to our series, A Day in the Life of a U.S. Investment Banker. In our first chapter, we followed our junior analyst through the pre-dawn hours, a strategic rush of information gathering and preparation that set the stage for the day. As we left off, the senior bankers were arriving, the day's priorities had been assigned, and the U.S. markets were stirring to life. The real work, the core analytical grind of an investment banker, is about to begin. The primary task on our analyst's plate this morning is to work on a pitch book. This term is central to the life of a junior banker, and it represents a significant portion of their workload. So, what exactly is a pitch book? In simple terms, a pitch book is a highly detailed and customized presentation, essentially a sophisticated sales document. Its purpose is to convince a company, a potential client, to hire the bank for a specific, high-stakes transaction. This could be advising them on selling their company, helping them acquire a competitor, or guiding them through the process of an initial public offering, or IPO. A pitch book is not a generic brochure. Each one is tailor-made for the specific client and situation. It is the bank's way of saying, we understand your business, we understand your industry, and we are the best equipped experts to help you achieve your strategic goals. For the junior analyst, this means long hours spent in Microsoft PowerPoint and Excel, turning raw data and complex ideas into a compelling and visually perfect story. Let's break down the typical anatomy of a pitch book. It usually begins with a section highlighting the bank's credentials and recent successes in the client's industry. This builds credibility. Next, it will provide a detailed overview of the current market landscape. What are the key trends, opportunities, and challenges facing the client's sector? The heart of the pitch book, and where the analyst spends most of their time, is in the strategic and financial analysis. This section presents several potential strategic alternatives for the client. For example, if the client is a mid-sized tech company, the pitch book might explore the pros and cons of selling to a larger firm, acquiring a smaller startup, or raising capital to fund growth. For each of these alternatives, the analyst must provide rigorous supporting analysis. This leads to the most critical component, valuation. The central question in almost any major corporate transaction is, what is this business worth? Answering this is not guesswork, it's a disciplined process of financial analysis. The analyst is responsible for building the financial models and performing the valuation work that underpins the entire pitch. This brings us to the second task assigned to our analyst this morning: pulling comps. This is banker jargon for comparable company analysis. It's one of the primary methods used to estimate a company's value. The logic is quite intuitive, similar to how you might value a house. To understand what your house is worth, You look at the prices of similar houses that recently sold in your neighborhood. In the corporate world, comps involve identifying a group of publicly traded companies that are similar to the client's company in terms of industry, size, and growth profile. The analyst then dives into financial databases like Bloomberg or FactSet to gather vast amounts of data on these comparable companies, their stock price, earnings, revenue, and debt levels. From this data, they calculate various valuation multiples, such as the price-to-earnings ratio or the enterprise value-to-EBITDA ratio. These multiples provide a market-based benchmark for what the client's company could be worth. The analyst's job is to present this data in a clear, easy-to-understand format, often in a table or chart known as a football field chart, which shows valuation ranges from different methodologies. It is crucial to understand that this valuation work is part of a comprehensive advisory service for sophisticated corporate clients. It is a complex estimation based on public data and proprietary models, not a simple formula for predicting stock prices, or a guide for personal investing. Back at the desk, our analyst is now deep in what is often called the engine room. The monitors are filled with sprawling Excel spreadsheets and blank PowerPoint slides. The work is a meticulous and often repetitive cycle of pulling data, checking it for accuracy, building charts, and writing concise explanations. The pressure is immense because even a small mistake can undermine the credibility of the entire presentation. The workflow is rarely linear. Around 10 a.m., the associate, the analyst's direct manager, comes over to the desk. They review the first draft of the valuation slides. The font on this chart title is size 10, but the standard is 9.5. Let's also add another company to this comp set. I think they're a better peer. And can you change the color scheme to match the client's logo? These seemingly minor requests are constant. The process of refining a pitchbook is known as turning or making edits, and a single slide might go through 20 or 30 versions before it's considered client-ready. This is the reality of the grind. It's a relentless pursuit of perfection, driven by the high expectations of both senior bankers and clients. The environment is one of extreme urgency. An email from the VP might come in with the subject line urgent. A client call might be moved up, forcing the team to condense 8 hours of planned work into 3. As noon approaches, the concept of a traditional lunch break is often non-existent. Lunch is typically a sandwich or a salad delivered directly to the office, eaten at the desk in between updating spreadsheets and aligning logos on a slide. The focus cannot be broken. Every minute counts, especially when a multi-billion-dollar deal is on the line. By midday, our analyst has made significant progress. A dozen slides for the pitchbook are in a draft stage, the comparable company analysis is taking shape, and the financial data has been triple-checked. However, the work is far from over. The initial drafts will now go up the chain of command, from the analyst to the associate, then to the VP, and ultimately to the managing director. Each level will provide their own feedback, critiques, and requests for new analysis, often sending the analyst right back to the drawing board. This iterative process ensures the final product is flawless, but it is also the primary reason why an investment banker's day rarely ends at 5 p.m. The morning has been a whirlwind of data, analysis, and intense focus. The analyst has functioned as a combination of financial detective, data scientist, and graphic designer. They have taken the raw, chaotic material of the market and begun to shape it into a clear, strategic narrative. Join us in Chapter 3, as the afternoon brings new challenges. We'll explore the world of live deals, unpredictable client requests, and the critical communication skills required to navigate the fast-paced second half of a day in the life of an investment banker. Welcome back to A Day in the Life of a U.S. Investment Banker. In our last chapter, we were immersed in the engine room, observing the meticulous and high-pressure process of building a pitchbook. Our analysts spent the morning deep in financial models and valuation analysis, crafting the story the bank would use to win new business. As we move into the afternoon, however, the day is about to take a sharp, unexpected turn. The world of investment banking is divided between two main activities: pitching for new deals and executing live deals. The afternoon is when the unpredictability of a live deal often takes center stage. Around 1:30 p.m., just as our analyst is getting into a rhythm with the pitchbook edits, a high-priority calendar invitation pops up. The title is simple: Project Titan Update. The meeting is in 10 minutes. Project Titan is the code name for an active, confidential deal the team is working on. This isn't a pitch anymore. This is a live transaction where the bank has already been hired to advise a major client on a potential acquisition. When an email or meeting request related to a live deal comes through, everything else becomes a secondary priority. This is the beginning of what is commonly known as a fire drill. A fire drill is a sudden, urgent task that requires the immediate and focused attention of the entire deal team. It's an all-hands-on-deck moment, sparked by an unexpected client request, a new piece of information, or a sudden development in the negotiation process. The team quickly gathers in a conference room. The managing director, or MD, who leads the client relationship, gets straight to the point. The client they are advising has been granted access to the target company's virtual data room, and they need the banking team to immediately begin the due diligence process. Let's pause to understand these critical terms. Due diligence is the comprehensive investigation and verification of a company's financial and operational health before a transaction is completed. Think of it as a home inspection on a massive scale. Before buying a company for hundreds of millions or even billions of dollars, the buyer needs to know everything. Are there any hidden liabilities, legal issues, or operational problems? The bank's role is to act as the client's expert investigator, poring over the target company's internal documents to identify risks and opportunities. The Virtual Data Room, or VDR, is the secure online portal where this investigation happens. The target company uploads thousands upon thousands of sensitive documents, financial statements, customer contracts, employee agreements, intellectual property records, and more, into this controlled environment. For the junior analyst, the VDR is about to become their entire world for the next several hours, or even days. Back in the meeting, the directive is clear. The VP turns to the team and begins assigning tasks. "Alex," he says, "I need you to log into the VDR immediately. Start by downloading all the board meeting minutes from the last 3 years, and the top 20 customer contracts. I want you to review those contracts and summarize any clauses related to change of control." This is a highly specific and crucial task. A change of control clause in a contract might allow a customer to terminate their agreement if the company is sold, which represents a major risk for the acquirer. The fire drill has officially begun. Our analyst rushes back to their desk, the half-finished pitchbook now a distant memory. Logging into the VDR, they are met with a complex folder structure, containing a staggering amount of information. The work is not glamorous. It involves downloading large files, meticulously organizing them, and reading through dense legal and financial documents, searching for specific pieces of information. The analyst is on the front line, sifting through the raw data to find the nuggets of information that the senior bankers need. This process highlights the critical importance of communication within the deal team. The analyst isn't working in a vacuum. A constant stream of instant messages and emails flows between them, the associate, and the VP. Have you found the summary of their debt agreements yet? What's the revenue from their largest customer for the last fiscal year? Please create an Excel sheet tracking all the key employee compensation packages. The analyst must be able to find this information quickly and present it clearly and accurately. There is zero room for error. A wrong number or a misinterpreted clause could have serious implications for the client's decision-making process. By 3:30 p.m., the initial phase of the fire drill is in full swing. Our analyst is deeply focused, scanning documents and building summary reports. But the other work hasn't disappeared. The associate messages them. "Hey, I know you're swamped with Project Titan, but the MD still wants to see an updated version of that Acme pitchbook by 6 p.m. This is the ultimate juggling act of a junior banker. The ability to manage multiple high-stakes projects simultaneously is a core requirement of the job. The analyst now has to compartmentalize their focus, switching between the urgent due diligence review and the important pitchbook revisions. The mental strain is significant. The pace is relentless. There is no downtime, no moment to relax. The afternoon is a blur of spreadsheets, legal documents, and a constant flow of communication. The role of the junior analyst in a live deal is to be the master of the details. While the senior bankers are on calls with the client, discussing strategy and negotiation tactics, the analyst is the one providing the foundational data that makes those high-level conversations possible. They are the fact-checkers, the data miners, and the organizers who ensure the team has a complete and accurate picture of the situation. It's a task that requires immense patience, organization, and an unwavering attention to detail, all under the crushing pressure of tight deadlines. As the afternoon wears on, the initial findings from the due diligence process are being compiled. The analyst has created a summary of the key contract terms, which has been sent up the chain to the VP. The VP is now using that summary to draft an update for the client. This is how the information flows. From the raw data in the VDR, through the analyst synthesis, and finally into the strategic advice delivered by the senior bankers. The fire drill has completely consumed the afternoon. The proactive, creative work of the morning has been replaced by a reactive, investigative sprint. This pivot demonstrates the dynamic and often unpredictable nature of the job, where a single email can change the course of an entire day. Join us in Chapter 4, as the business day officially comes to a close for the rest of the world. We will explore what the evening and late-night hours truly hold for a junior banker, a time when the myth of the 100-hour work week becomes a stark reality. Welcome back to a day in the life of a U.S. investment banker. The afternoon was a chaotic pivot, a high-stakes fire drill on a live deal that demanded our analysts' immediate and undivided attention. Now, as the clock strikes 6 p.m., a distinct shift occurs. For most of the corporate world, this is the end of the workday. Briefcases are closed, offices go dark, and the city's workforce begins its commute home. But for an investment banking deal team, this is often the beginning of the second shift, the time when the most focused and intensive work gets done. The office atmosphere transforms. The ambient buzz of the trading floor fades. The phones stop ringing as frequently, and most senior executives and support staff depart for the evening. What's left is a core group of analysts and associates, the soldiers in the trenches, settled in for a long night. There's a quiet, intense energy. This period, from the early evening until the early hours of the morning, is ironically when junior bankers are often at their most productive. With fewer meetings, calls, and interruptions, they can finally engage in the deep, uninterrupted work required to perfect financial models and presentations. Around 7 p.m., the next critical phase of the workflow begins, incorporating senior feedback. The vice president, having reviewed the draft of the Acme Corporation pitchbook that our analyst was working on, sends back his comments. This isn't a simple email with a few suggestions. It's a markup. The VP has printed the PowerPoint slides and marked them up with a red pen, or provided digital comments, detailing every required change. This turn or markup is a fundamental part of the investment banking process. The feedback can range from minor cosmetic tweaks, align these logos, fix the footnote formatting, to substantial analytical requests, let's add a different valuation methodology here. Or the narrative on this slide isn't compelling. Rewrite it to focus on synergy potential. For the analyst, this means methodically going through every single comment and executing each change with absolute precision. This process is iterative and demanding, as one change can have a ripple effect, requiring adjustments to numerous other slides and calculations. As our analyst works through the markup, another nightly ritual begins, the team dinner. This is rarely a social outing. Instead, a menu from a local restaurant is passed around, and everyone places an order paid for by the firm. The food arrives in takeout containers and is eaten at their desks, often in between updating spreadsheet cells and revising slides. While it provides a brief moment of camaraderie, with analysts and associates sharing a quick conversation over their meals, the work never truly stops. The glow of the monitors is a constant companion to the meal. Tonight, our analyst is still juggling. The urgent due diligence work for Project Titan, the live deal, continues to be a priority. They are cross-referencing documents from the virtual data room, while simultaneously addressing the pitchbook comments. The mental agility required to switch between two completely different projects, one an investigative deep dive, the other a creative sales presentation, is immense. This is where the ability to organize, prioritize, and manage time under extreme pressure becomes a critical survival skill. By 9 p.m., the pitchbook is in its fourth or fifth version of the day. Each time the analyst finishes a round of edits, they send the file to the associate for review. The associate, who acts as a crucial filter and manager, reviews the work, adds their own comments, and then decides if it's ready to be sent back up to the VP. This hierarchical review process is designed to ensure that by the time a document reaches the client-facing managing director, it is as close to perfect as possible. This late-night period is also highly collaborative. Analysts often rely on each other, asking for a quick second look at a complex formula, or for help finding a specific piece of data. There's a shared understanding of the pressure they are all under, which fosters a unique, sleeves-rolled-up bond. They are all in it together, navigating the same challenges and striving for the same standard of excellence. Some banks also have dedicated desktop publishing, or DTP teams, who work overnight to help with formatting and visual presentation, allowing the analysts to focus more on the financial substance. As the night deepens, the city outside grows quiet. The towering office building becomes a beacon of light, a testament to the work still being done within. For our analyst, the combination of mental fatigue and caffeine is beginning to set in. The challenge is no longer just about completing the work. It's about maintaining the same level of accuracy and attention to detail at 11 p.m. as they had at 11 a.m. In a world where a single misplaced decimal point can change the output of a valuation model, there is no room for carelessness. The second shift is not just about logging hours. It's a structured, intense period of refinement and execution. It's where the raw materials gathered and analyzed during the day are forged, through countless iterations, into the polished, high-impact deliverables that are the hallmark of the investment banking industry. Join us in Chapter 5. As we push into the final stretch of the day, we'll explore the challenges of the late-night hours, the final push to meet morning deadlines, and the crucial question of when and if the day for an investment banker ever truly ends. Welcome back to a day in the life of a U.S. investment banker. We've journeyed through the pre-dawn market prep, the analytical grind of the morning, a high-stakes afternoon fire drill, and the focused second shift of the evening. Now we enter the quietest and perhaps most challenging phase of the day, the late-night hours. The clock on the wall reads 11:30 p.m. The initial adrenaline of the day has long since faded, replaced by a deep-seated fatigue. This is the final mile of the marathon, a true test of endurance, precision, and mental fortitude. The office is now a shell of its daytime self. Only a handful of lights remain on, illuminating the small pockets of deal teams still at their desks. The energy is muted but hyper-focused. This late at night, the work becomes purely about execution. For our analysts, the primary goal is to bring the Acme Corporation Pitchbook to a state of completion. After several rounds of revisions with the associate and the VP, the latest version, version 8.0, has been sent up the chain to the managing director for the final sign-off. This period can be an anxious one. The analyst and associate are in a holding pattern, waiting for the verdict from the top. The MD might be reviewing the presentation from home after a client dinner, or from a hotel room on a business trip. Their feedback is the final gate the work must pass through. In the meantime, our analyst uses this lull to continue chipping away at the due diligence work for Project Titan, the live deal, methodically logging findings from the data room. Just after 12:45 a.m., an email arrives from the MD. It's not the simple "looks good" print for the morning that everyone was hoping for. The MD is a seasoned banker with decades of experience, and his instincts are sharp. His feedback is concise but significant. Good work. However, the market is volatile. Please add a new appendix slide detailing potential risks and mitigation strategies for the proposed transaction. We need to be prepared for tough questions. Thanks. This is a classic late-night scenario. A new, thought-provoking request that requires fresh analysis, not just minor edits. While frustrating, it's a crucial part of the value the bank provides, thinking ahead and anticipating client concerns. There are no groans or complaints, just quiet acceptance. The team immediately gets back to work. A new task has been added to the final stretch. Working at this hour presents unique challenges. Simple tasks become more difficult as mental exhaustion sets in. The risk of making a careless error, a typo in a headline or a broken formula in a spreadsheet, increases tenfold. This is where discipline and process become paramount. Our analyst meticulously double-checks every number and every source. They might ask another analyst working late on a different deal to give a fresh set of eyes to the new slide, a common practice of peer reviewing to catch mistakes that tired eyes might miss. By 2 a.m., the new risk analysis slide is complete and has been incorporated into the presentation. The entire pitch book is reviewed one last time, from the first page to the last, ensuring perfect consistency in formatting, language, and data. The analyst then sends the final version, now labeled V9_final, to the entire team and to the bank's print production center with instructions for it to be printed, professionally bound, and ready for the MD before his first meeting at 8 a.m. A sense of weary accomplishment settles in. The primary task that started almost 20 hours ago is finally done. Now the day can truly end. The wrap-up process is methodical. Our analyst organizes all the files on their computer, clears their email inbox, and writes a concise to-do list for the next day, which is now only a few hours away. This ensures a clean slate and a clear set of priorities for when they return. Finally, around 2:30 a.m., it's time to go home. Stepping out of the climate-controlled, brightly lit office into the stillness of the deserted city is a surreal experience. The bustling metropolis has been silenced, and the streets are empty. For safety and convenience, the bank provides a late-night car service. During the silent ride home, there's a moment to decompress. The analyst might scroll through personal messages or listen to music, a brief window of disconnection before the cycle begins again. The door to the apartment closes around 3 a.m. The day, which began before the sun rose, has finally concluded long after the moon has reached its peak.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
It was a day defined by relentless analysis, unpredictable pivots, and an unwavering commitment to perfection, right down to the final minute. Join us in our next chapter as we explore what comes after this grueling day. How does one rest, recover, and prepare to do it all over again in just a few short hours? We'll look at the human element of this demanding career and the mindset required to sustain it. Welcome back to a day in the life of a U.S. investment banker. In our last chapter, we followed our analyst through the final, grueling hours of a workday that stretched to nearly 22 hours, culminating in a 3 a.m. arrival home. The work was done, the deadline was met. But that raises a critical question. What happens next? When the marathon is over, how does the runner prepare for another race that begins in just a few short hours? This chapter explores the crucial, yet often overlooked, human element of the job: the reset. First, it is important to state our usual disclaimer. The following chapter describes lifestyle patterns and coping mechanisms often found in high-stress professions. It is for informational purposes only and is not intended as health, wellness, or lifestyle advice. For our analyst, walking through their apartment door doesn't mean instant sleep. The mind, after running at maximum capacity for almost an entire day, cannot simply switch off. The body is exhausted, but the brain is still buzzing with adrenaline and cortisol. It's still processing the details of the financial model, the feedback from the managing director, and the to-do list for the coming day. Decompression is a necessary, albeit brief, process. This might involve 20 minutes of watching a mindless show, scrolling through social media to reconnect with the outside world, or quickly reading personal text messages that were ignored for hours. It's a small attempt to shed the professional armor before a brief period of rest. The concept of a full night's sleep is a luxury that doesn't exist in this scenario. The goal is damage control. Our analyst sets 3 separate alarms, spaced 2 minutes apart, starting at 6:45 a.m. Doing the math is sobering. If they fall asleep by 3:30 a.m., that leaves just over 3 hours for sleep. This isn't a healthy or sustainable pattern, but for a junior banker on a demanding deal, it is sometimes the reality of the job. It is viewed as a short-term sacrifice, part of paying your dues in the early years of one's career. When the alarm rings, it feels less like a wake-up call and more like an interruption. The physical and mental exhaustion is immense. Every instinct screams for more rest, but the discipline forged in the workplace takes over. There is no option to hit snooze repeatedly. The day has already begun. The next hour is what can be called the reset routine, a highly disciplined personal process designed to reboot the system for another demanding day. For some, this involves a physical shock to the system. Our analysts might head straight to their building's gym for a quick, 20-minute high-intensity workout. The purpose isn't about long-term fitness goals. It's about forcing the body awake, boosting endorphins, and clearing the mental fog. For others, it might be a cold shower or a quick run. These are mechanisms to combat the profound fatigue. Next comes the mental reset. While sipping a strong coffee, the analyst will put on the uniform, the suit and tie. This simple act is psychological. It's about mentally preparing for the professional challenges ahead, much like an actor getting into costume. During this time, the phone is already active. A quick scan of the news ensures they are aware of any major overnight market-moving events. A first pass through their email inbox reveals the priorities for the day. The cycle is already restarting. This raises the question of why. Why would anyone choose a lifestyle with such intense demands and so little time for personal well-being? The motivations are complex and personal, but often center on a few key themes. The first is the unparalleled learning experience. A junior banker in their first 2 years is exposed to a volume and complexity of financial transactions that is unmatched in almost any other profession. They are, in essence, getting a real-world MBA in high-stakes corporate finance. Second are the future career opportunities. The skills, discipline, and network built during these intense years are seen as a launchpad to a wide range of prestigious careers in private equity, hedge funds, or executive roles at major corporations. The experience is viewed as a form of currency that can be cashed in for future opportunities. And of course, there is the financial compensation. which is a significant factor in attracting talent willing to endure the demanding lifestyle. However, this comes at a cost. Hobbies, personal interests, and social relationships are often put on the back burner. The relentless schedule can make it incredibly difficult to maintain connections with friends and family outside of the industry. It's a life of trade-offs, where professional ambition is prioritized above almost everything else, at least for a finite period. As our analyst steps out the door around 7:45 a.m., grabbing a coffee on their way to the office, they look and act the part of a polished professional. But underneath that exterior is the reality of just a few hours of sleep, and the immense pressure to perform at an elite level all over again. The reset, therefore, is not true recovery. It's a rapid, focused, and highly disciplined effort to prepare the mind and body for the next round. Join us in Chapter 7, as we explore what a typical day might look like. When there isn't a single, all-consuming deadline or fire drill, how does an analyst spend their time? We'll delve into the variety of tasks, internal meetings, and training that fill a more standard day in the life of an investment banker. Welcome back to A Day in the Life of a U.S. Investment Banker. After enduring a nearly 22-hour workday followed by a brief and inadequate period of rest, our analyst is back at their desk. The previous day was a sprint, dominated by a single, all-consuming Pitchbook deadline, and an urgent fire drill on a live deal. Today, however, promises a different kind of challenge. Not every day involves a frantic, down-to-the-wire push. Many days are a masterclass in multitasking, requiring the analyst to manage multiple projects and priorities simultaneously. As our analyst settles in, the fatigue is a tangible presence, but the muscle memory of the routine takes over. The morning begins, as always, with a scan of the markets and a team huddle. But today, the VP's instructions aren't focused on one single deliverable. Instead, the tasks are spread across various projects, each at a different stage of its life cycle. The first assignment is for Project Titan, the live deal from yesterday. The request is simple but ongoing. Keep an eye on the virtual data room for any new document uploads and log them. This is a monitoring task, requiring periodic checks throughout the day. The second task is for a new, potential pitch. We're thinking about approaching a company in the renewable energy space, the VP explains. Alex, start by putting together a preliminary list of potential strategic acquirers for them. I want a list of 20 to 30 logical buyers by the end of the day. The third task is an internal one. The new quarterly league tables just came out. Please update our team's credentials and precedent transaction slides for all our pitch books. This collection of tasks paints a much broader picture of an analyst's responsibilities. The first is about diligence, the second about strategic thinking, and the third about essential marketing and maintenance. Our analyst spends the first part of the morning on the second task, generating ideas. This is one of the more creative aspects of the job. It involves deep research, using financial data terminals, industry reports, and news archives to identify companies that would be a good strategic fit to buy the potential client. The analyst isn't just looking for the biggest companies. They're looking for a compelling story. Would the acquisition expand the buyer's geographic reach? Would it give them access to new technology? This work is foundational, forming the basis of the strategic recommendations the bank will eventually make. Next, our analyst pivots to the third task, updating the league tables and credentials. This is a less glamorous but critically important part of the job. League tables are rankings, compiled by financial data providers, that show which investment banks have advised on the most deals by value or volume in a given period. Having a high ranking is a key marketing tool. The analyst's job is to take this new data and carefully insert it into the standardized PowerPoint slides that are used across all the team's presentations. It is meticulous, detail-oriented work. Every number, logo, and footnote must be perfect, as these slides are the bank's resume, presented to every potential client. Around noon, a calendar notification pops up for a mandatory training session. Even on busy days, continuous learning is a core part of the culture. Today's session is a 1-hour webinar on recent trends in M&A deal structuring. During this session, a senior banker or an external expert will walk the junior staff through new and innovative ways that deals are being put together. This is not just a break from the regular work. It's a vital part of an analyst's development, providing them with the knowledge they'll need as they become more senior. It also serves as a reminder that the world of finance is constantly evolving, and staying current is essential. Lunch, once again, is a quick meal at the desk. During this time, our analyst multitasks, eating while also handling a stream of small, ad hoc requests. An associate might ask them to find and send a specific news article. A VP might need a company's current stock price and market capitalization for a client call they are about to join. A managing director might walk by and ask for a quick summary of a company they just read about. Being responsive, resourceful, and maintaining a positive, can-do attitude in the face of these constant small interruptions is a key, unwritten part of the job description. The afternoon is spent juggling these various work streams. A few hours are dedicated to finalizing the list of potential acquirers, which is then sent to the associate for review. In between, the analyst checks the Project Titan data room every hour for new files. They also complete the credentials update, sending the new slides to the team's administrative assistant to be distributed. This type of day, while lacking the intense drama of a single deadline, is challenging in its own way. It requires a different set of skills: superior organization, the ability to seamlessly switch contexts between different industries and tasks, and flawless time management. It demonstrates that an analyst's value is not just in their ability to grind through the night on one project, but also in their capacity to effectively manage a diverse and ever-changing workload. Join us in Chapter 8 as we shift our focus from the desk to the people. So far, our analyst has been immersed in data and documents. Next, we will explore the world of communication and interpersonal dynamics, from internal team interactions to the first, carefully managed exposures to the most important people in the business: the clients. Welcome back to a day in the life of a U.S. investment banker. In our previous chapters, we focused intensely on the analytical and executional aspects of the job: the models, the presentations, and the relentless pace of the work. But the world of investment banking is not just built on spreadsheets and data. At its core, it is a relationship business. The most sophisticated financial model is meaningless if the ideas it represents cannot be communicated clearly and persuasively. This chapter delves into the human element, the critical role of communication, navigating the internal hierarchy, and the first steps of client interaction. The flow of information within a deal team is highly structured. It follows a clear hierarchy designed for efficiency and quality control. The primary line of communication for our analyst, Alex, is with his immediate superior, the associate. The associate acts as a project manager and a mentor, assigning tasks to the analyst, answering questions, and providing the first round of review on all work. The analyst's job is to keep the associate constantly informed, a practice known as managing up. This means providing proactive status updates, flagging potential problems before they escalate, and asking intelligent, clarifying questions. The associate, in turn, synthesizes the analyst's work and reports to the vice president, or VP. The VP is the day-to-day leader of the deal, managing the overall timeline and strategy. The VP communicates progress and key findings to the managing director, or MD, who is responsible for the high-level client relationship and business development. Understanding this chain of command is crucial for an analyst. It ensures that information flows smoothly, and that senior bankers' time is used for strategic oversight, not for getting lost in the granular details. This dynamic is on full display during internal meetings. Let's imagine that in the mid-afternoon, the team on Project Titan gathers for a quick status update. In this meeting, our analyst's role is primarily to be a sponge and a scribe. He is expected to listen intently, absorbing the strategic discussion between the senior bankers. He needs to be prepared to answer any detailed, technical question about the data he has been reviewing, but he is not expected to offer opinions or strategic ideas. His most important active role is to take meticulous notes, capturing every decision made and, most critically, every action item, or next step, that needs to be completed. Later that afternoon, a significant milestone occurs. The VP invites Alex to listen in on a scheduled call with the client of Project Titan. For a junior analyst, this is a major step. It's the first real exposure to the client-facing side of the business. Before the call, the VP sets clear expectations. "Alex," he says, "your role on this call is to be in listen-only mode. Mute your line and do not speak unless I directly ask you a question. Your job is to take the most detailed notes you possibly can. I want you to capture not just what we say, but the client's questions, their tone, and any specific concerns they raise. After the call, you'll be responsible for writing the first draft of our internal summary and the list of follow-up items." During the call, the contrast in communication styles is striking. The conversation, led by the MD and VP, is polished and professional. They translate the complex, internal analysis into clear, high-level strategic advice for the client, who might be a corporate CEO or CFO. The internal jargon is gone, replaced by a language of business strategy and client focus. For Alex, listening to this is like watching a masterclass in professional communication and client management. He hears firsthand the types of questions clients ask and learns how senior bankers navigate difficult topics with poise and confidence. The moment the call ends, the internal debrief begins. The VP immediately turns to Alex and the associate. Okay, what were the key takeaways? What are our follow-ups? Alex refers to his detailed notes, helping the team piece together a complete picture of the conversation and solidify the list of tasks they now need to perform for the client. His role as a silent observer was not passive. It was a critical function that ensures no detail or client request is missed. Following the debrief, Alex is given his first opportunity to contribute to the client dialogue, albeit indirectly. He is tasked with drafting the internal summary email of the call and a list of the action items. This draft will not be sent to the client. It is a purely internal document that will be reviewed, edited, and rewritten by the associate and VP before they craft the official client communication. This process, however, is a vital training exercise. It teaches the analyst how to synthesize a conversation, identify key deliverables, and begin to think about how to communicate with clients in a structured and professional manner. This day has been less about frantic modeling and more about observation and integration. Our analyst is learning that being a successful banker requires more than just technical skill. It requires an understanding of people, hierarchy, and the art of communication. Join us in Chapter 9, as we explore one of the most exciting and high-stakes events in a banker's life, the announcement of a major deal. We'll examine the role an analyst plays when a transaction goes from being a confidential project to a front-page news story. Welcome back to A Day in the Life of a U.S. Investment Banker. We've spent a great deal of time exploring the behind-the-scenes work, the confidential analysis, the late-night revisions, and the internal meetings. But what is all this work for? Often, the goal is a single, transformative moment, the public announcement of a major transaction. This chapter takes you inside one of the most exciting and high-stakes days in banking, Deal Day. For months, our analyst and his team have been working on a secret project, codenamed Project Voyager. It's a merger between two large, publicly traded companies. The work has been conducted under the strictest confidentiality. Today, that is all about to change. The deal is set to be announced to the world at 7 a.m. Eastern Time, before the U.S. stock markets open. The atmosphere in the office is electric. The energy is a stark contrast to the quiet, heads-down focus of a normal day. There's a palpable sense of anticipation and nervous excitement. This is the culmination of countless hours of work. The hours leading up to the announcement are a flurry of controlled chaos. The analyst's role shifts from analysis to final verification. He is tasked with a critical job, cross-checking every number and key phrase in the official press release against the final, signed legal agreements. Is the deal value stated correctly down to the last decimal? Are the names and titles of the executives accurate? In a public announcement, there is zero room for error. A single mistake can cause market confusion and damage the credibility of the transaction. Simultaneously, the deal team joins a massive conference call. On the line are the senior bankers, lawyers from both companies, and the public relations firms for both the buyer and the seller. This call is a logistical synchronization. The group choreographs the exact moment the press release will be sent over the wire, when the new deal website will go live, and when emails will be sent to the employees of both companies. Our analyst is on the call, taking meticulous notes, and ensuring his team is aware of the final sequence of events. At precisely 7 a.m., the button is pushed. The press release hits the major newswires. Instantly, Project Voyager ceases to be a secret. It becomes a major international news story. On our analyst's multiple monitors, alerts flash across his Bloomberg terminal. The headlines appear on the websites of the Wall Street Journal, Reuters, and other major financial news outlets. The ticker symbols of the two companies are suddenly the main topic of conversation on financial television. Seeing the project you've poured your life into for months become front-page news is a uniquely rewarding and surreal experience. But there is no time to celebrate. The next phase begins immediately. The investor conference call, scheduled for 8:30 a.m. On this call, the CEOs and CFOs of the two companies will present the strategic rationale for the merger to hundreds of Wall Street research analysts and major investors. The junior team's role during this call is to operate in a war room setup, supporting the senior bankers who are with the client. Our analyst is in a conference room with his associate and VP, listening to the live audio feed of the call. His financial model is open, and all the deal documents are at his fingertips. His job is to be a real-time fact-checker and data provider. When a tough question comes from a sharp-eyed research analyst, for example, what is the projected impact of this merger on the company's debt-to-equity ratio in year 3? The MD advising the client might instantly message the team for the answer. Our analyst needs to be able to find that specific data point in his model within seconds and send it back. He is also monitoring the real-time stock price reactions of both companies as the call progresses. Once the investor call concludes, the work is still not over. The announcement is just the beginning. The bank will now assist the client in managing the weeks and months of follow-up communications with investors, credit rating agencies, and employees. The analyst will be responsible for tracking market commentary on the deal and helping to prepare materials for these follow-up meetings. Around mid-morning, with the announcement successfully made and the investor call complete, there is a brief, collective exhale. The managing director might gather the team for a quick huddle. "Great job everyone," he'll say. "This was a massive team effort. Thank you for all the hard work." This moment of recognition is incredibly powerful. It connects the months of grueling, abstract work behind the screen to a tangible, impactful, real-world event. It's a powerful reminder of the significance of the work and a major source of motivation. Deal Day is a unique blend of logistical precision, public scrutiny, and shared accomplishment. For a junior analyst, it's a front-row seat to the workings of the capital markets, and a day that makes the long nights and immense sacrifices feel worthwhile. Join us in Chapter 10, as we look beyond the announcement. A deal being announced is not the same as a deal being closed. We will explore the lengthy and complex next steps, from navigating regulatory hurdles to the detailed work of deal integration. Welcome back to a day in the life of a U.S. investment banker. In our last chapter, we experienced the peak excitement of Deal Day. The adrenaline-fueled moment, a confidential project, becomes a global news story. It's easy to assume that with the press release out and the investor call complete, the most challenging work is over. However, this is a common misconception. Announcing a deal is not the same as closing a deal. The period between announcement and closing is a marathon, not a sprint, and it requires a different kind of endurance, shifting the analyst's role from high-level analysis to meticulous, long-term project execution. With the initial excitement of the Project Voyager merger announcement fading, the team's focus pivots to a new, more procedural phase. The work becomes less about valuation and more about documentation and regulatory processes. For our analyst, Alex, this means his daily tasks are now dictated by legal requirements and procedural timelines rather than last-minute client requests. A major hurdle for any large merger is securing regulatory approval. In the United States, government bodies like the Department of Justice, DOJ, and the Federal Trade Commission, FTC, must review the transaction to ensure it doesn't harm competition in the marketplace. This is a complex and lengthy legal process. The investment banker's role is not to provide legal advice, that is the domain of the lawyers, but to provide the data and analysis that supports the legal filings. For instance, the legal team might need to understand the market share of the newly combined company in dozens of different product categories. It becomes our analyst's job to dive back into the data, building detailed spreadsheets and charts that clearly illustrate this information. He might spend days analyzing industry reports and sales data to provide the lawyers with the precise figures they need to make their case to the regulators. This is painstaking work, where every number must be accurate and sourced. Simultaneously, the team must work on various filings for the Securities and Exchange Commission, or SEC. For a merger involving public companies, one of the most significant documents is the Form S-4 registration statement. In simple terms, the S-4 is a massive document that provides shareholders of both companies with all the necessary information to make an informed decision on whether to approve the merger. It includes the full terms of the transaction, detailed historical financials, pro forma financial projections for the combined company, and a discussion of the risks involved. The analyst is a key player in drafting the financial sections of this document. This is a far cry from creating a punchy PowerPoint slide. It involves writing dense, technical prose and ensuring that every single number presented in the document ties perfectly back to the master financial model and the legal merger agreement. The process is incredibly iterative. The analyst will draft a section, the associate and VP will review it, then the lawyers and accountants for both companies will provide their comments, often resulting in multiple rounds of revisions. This process can take weeks, requiring an extraordinary level of attention to detail. While this public filing process is underway, the due diligence work also continues. The focus now is on confirmatory diligence, verifying all the final details, and more importantly, on integration planning. The client needs to figure out how to combine these two massive companies smoothly, To support this, our analyst might be tasked with new types of analysis. For example, he might create a detailed comparison of the two companies' real estate leases, their key supplier contracts, or their sales force compensation structures. This work provides the client's management team with the data they need to start building a practical plan for operating as a single entity post-merger. This phase of the deal lacks the glamour and adrenaline of the pre-announcement stage. The work is a grind. It requires immense organizational skills. Analysts live by checklists and project plans, tracking dozens of different work streams and deadlines simultaneously. The satisfaction comes not from a single exciting event, but from methodically moving a highly complex project one step closer to the finish line, day by day. The post-announcement period is a testament to the fact that an investment banker's job is not just about big ideas and high-stakes negotiations. It's also about rigorous process management and a relentless commitment to seeing a transaction through every single, painstaking step until the day it officially closes. Join us in Chapter 11, where we will pivot from the world of mergers and acquisitions to another critical function of investment banking: capital markets. We'll explore what happens when a company wants to raise money, whether through an initial public offering, IPO, or by issuing bonds, and the unique role an analyst plays in that process. Welcome back to a day in the life of a U.S. investment banker. Thus far, our journey has been deeply entrenched in the world of mergers and acquisitions, or M&A, where we advise companies on buying or selling other companies. But that is only one side of the business. The other major function of an investment bank is to help companies raise capital. This is the domain of the capital markets groups. This chapter explores this critical function, pivoting from M&A to the dynamic processes of an initial public offering, or IPO, and a debt offering. Let's imagine our analyst, Alex, is now assigned to a new project. A successful, fast-growing private technology company has decided it wants to go public through an IPO. This means they will sell shares to the public for the first time, listing on a stock exchange like the Nasdaq or the New York Stock Exchange. The company needs to select an investment bank to lead them through this complex process. This leads to an intense competition known as a bake-off, or a beauty pageant. Several top investment banks are invited to present to the company's board of directors. Our analyst is now part of a team working around the clock to create the pitchbook for this bake-off. The content is different from an M&A pitch. The focus is on demonstrating the bank's expertise in the company's industry, its track record of successful IPOs, its deep relationships with major institutional investors, and most importantly, its view on the company's valuation. Alex spends his days building financial models to estimate what the company could be worth as a public entity, and creating slides that tell a compelling story about the company's future growth potential. Once the company selects our analyst's bank as the lead underwriter, the real IPO process begins. This is an incredibly document-intensive exercise. The central document is the Form S-1 registration statement, which is filed with the SEC. We touched on this in our M&A discussion, but for an IPO, the S-1 is the company's introduction to the investing public. It is a comprehensive prospectus containing everything an investor would need to know: the company's history, its business model, its management team, its financial performance, and crucially, the risks of investing. The analyst's role in drafting the S-1 is vital. He becomes a master of the company's data, working closely with the company's finance team and the lawyers to ensure every number in the document is accurate and every business description is precise. He is responsible for building and maintaining the core financial model that underpins all the financial disclosures in the S-1. It's a months-long process of drafting, revising, and responding to comments from the SEC. While M&A is about advising on a transaction between two companies, capital markets work is about connecting a single company with the vast world of public investors. A different skill set comes to the forefront. Let's consider another scenario. A large, established public company doesn't need to sell shares, but wants to raise money by issuing bonds. They need to borrow a large sum of money, and they will do it by selling debt to institutional investors. This is the world of debt capital markets, or DCM. In this case, the analyst's work is focused on credit, not equity. His job is to help prepare a different kind of marketing document, an offering memorandum. He will build financial models that focus on the company's ability to generate cash flow and repay its debt. The key questions are different. It's not about how much the company can grow, but about how stable and reliable its earnings are. The story told to bond investors is one of safety, stability, and predictable returns. Whether it's an IPO or a debt deal, once the legal documents are in order, the marketing phase begins with a roadshow. During the roadshow, the company's senior management,
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Accompanied by senior investment bankers, will travel to major financial centers like New York, Boston, and London. They will conduct a series of presentations to large institutional investors, pension funds, mutual funds, and hedge funds, to generate interest in buying the new stock or bonds. During the roadshow, the analyst acts as the central information hub back at the office. He tracks the schedule, helps with last-minute presentation edits, and most importantly, assists in the book-building process. As investors express interest, the bankers build a book of orders. The analyst helps to track this demand, providing real-time updates to the deal team on how the roadshow is progressing. The data he helps to manage will be critical in making the final, crucial decision. At what price will the new shares or bonds be sold to the public? Working on a capital markets transaction gives an analyst a different perspective on the financial world. It's a direct look at how companies access the massive pools of capital that fuel their growth and operations. It requires the same analytical rigor and attention to detail as M&A, but with a unique focus on storytelling for a broad investor audience. Join us in Chapter 12, as we explore the culture of investment banking. Beyond the deals and the deadlines, what is the day-to-day environment really like? We'll discuss the unwritten rules, the importance of teamwork, and the unique pressures and rewards of being part of this demanding profession. Welcome back to a day in the life of a U.S. investment banker. We have navigated through the intense mechanics of the job, the late-night deal sprints, the complex M&A transactions, and the dynamic world of capital markets. But a job is more than just a series of tasks. It's an environment with its own distinct culture. This chapter pulls back the curtain on the day-to-day atmosphere of an investment bank, exploring the unwritten rules, the critical importance of teamwork, and the unique pressures that forge the analyst experience. The physical heart of the junior banker world is the bullpen. This is a large, open-plan seating area where the analysts and typically the associates sit together. There are no private offices here. The desks are arranged in rows, each equipped with an array of monitors. This design is intentional. It fosters constant communication and a high-energy environment. It also allows for rapid learning through osmosis, as analysts constantly overhear conversations between associates and VPs, absorbing the language and logic of the business. The culture is often described as an apprenticeship model. As a new analyst, you are at the bottom of a steep learning curve, and the expectation is that you will learn by doing. There is a strong sense of paying your dues. The grueling hours and meticulous, sometimes tedious, work are seen as a rite of passage. This mindset is built on the idea that to become a trusted advisor, you must first master the foundational details of the work, and that mastery can only be achieved through repetition and relentless effort. Hierarchy is a fundamental aspect of the culture, but it's more nuanced than it might appear. While the chain of command we've discussed, analyst to associate to VP to MD, is clear and respected, the day-to-day interaction is highly collaborative. The relationship between an analyst and their associate is particularly critical. A good associate acts as a teacher and a filter. They translate the high-level requests of the VP into actionable tasks for the analyst, and provide the first line of training and feedback. For an analyst, having a supportive associate who is willing to explain a concept for the third time at 1 a.m. can make all the difference. Teamwork is not just a corporate buzzword, it's a survival mechanism. No one succeeds in investment banking alone. When a fire drill hits, the entire deal team mobilizes. Analysts and associates will often work together late into the night, checking each other's work and brainstorming solutions to a problem. There is an unspoken understanding that you must be reliable. If you are tasked with completing a specific section of a presentation, your team is counting on you to deliver it on time, and without errors. Letting the team down is one of the biggest mistakes a junior banker can make. There are also many unwritten rules of etiquette that a new analyst must learn quickly. For example, responsiveness is paramount. An email from a senior banker, especially one marked urgent, requires an immediate reply, even if it's just to say received on it. Another rule is to never present a problem without also proposing a potential solution. This shows proactivity and an ability to think critically, not just execute instructions. Thoroughness is also key. Before asking an associate a question, an analyst is expected to have first made a genuine effort to find the answer themselves. The culture is also one of incredibly high standards. The pursuit of perfection is relentless. A pitchbook isn't just a collection of data, it's a reflection of the bank's brand. A single typo or misaligned logo can be viewed as a sign of carelessness, which is unacceptable when advising on multi-billion-dollar transactions. This pressure for flawlessness can be intense, but it also instills a level of discipline and attention to detail that is highly valued throughout the business world. Despite the pressure and the hierarchy, the bullpen can also be a place of significant camaraderie. The shared experience of navigating intense deadlines and complex challenges creates a powerful bond among the analysts. They are the only ones who truly understand the unique demands of each other's lives. This often results in strong friendships and a professional network that lasts for an entire career. The culture is a unique paradox. It is simultaneously highly individualistic in its demands for performance and deeply collaborative in its execution. Join us in Chapter 13, where we will address one of the most talked about aspects of this career, the lifestyle. We'll take an honest look at the reality of work-life balance, the financial rewards, and the personal sacrifices that are inherent to the life of a junior investment banker. Welcome back to A Day in the Life of a U.S. Investment Banker. We've delved into the complex deals, the demanding culture, and the mechanics of the job. Now, we turn to the topic that often generates the most curiosity and debate, the lifestyle. What are the tangible rewards for such a demanding career, and what are the personal costs? This chapter provides a realistic look at the compensation, the sacrifices, and the ongoing conversation around work-life balance in the industry. Before we proceed, it is critical to state our disclaimer. This chapter discusses general compensation structures and lifestyle topics for informational purposes only. It is not financial advice, career advice, or a guarantee of any specific outcome. Compensation and experiences can vary significantly between firms, locations, and individuals. Let's begin with compensation, as it is a primary motivator for many who enter the field. The financial rewards for a junior investment banker are significant, especially for a recent college graduate. The compensation structure is typically composed of two main parts: a base salary and an annual bonus. The base salary is a fixed, predictable amount paid throughout the year. It is generally competitive and well above the average starting salary for other industries. The second, and often more substantial, component is the year-end bonus. This is a variable amount that is typically paid out once a year, and is based on a combination of factors. These can include the overall performance of the bank, the performance of the analyst's specific group, and to a lesser extent at the junior level, the individual's own performance. This bonus can be a significant multiple of the base salary, and it is this combined figure that makes investment banking one of the most lucrative entry-level professions. It's important to understand this compensation is a direct trade-off for the immense time commitment and high-pressure environment. This brings us to the other side of the equation: the sacrifices and the reality of work-life balance. As our series has illustrated, the time commitment is extreme. The 80 to 100-hour work week is not always a constant, but it is a frequent reality, especially when working on live deals or urgent pitches. This schedule fundamentally shapes the life of an analyst. For most junior bankers, life outside of work becomes a matter of careful triage. Spontaneity is a luxury that is hard to afford. Dinners with friends, weekend trips, and even personal appointments often have to be scheduled tentatively, with the understanding that they are subject to last-minute cancellation due to a work emergency. This can be challenging for relationships with friends and family who are not in similarly demanding professions. Hobbies and personal interests are often put on hold. The limited free time an analyst does have is typically spent on essential life maintenance: sleeping, doing laundry, buying groceries, and simply recharging for the week ahead. The demanding nature of the job means that personal well-being, including physical and mental health, requires proactive and disciplined attention. In recent years, the conversation around this lifestyle has evolved. Many investment banks have recognized the challenges of burnout and have implemented policies aimed at improving the junior banker experience. These can include protected weekends, where analysts are encouraged not to work from Friday evening until Sunday morning, except in the case of a truly urgent live deal. Some firms have also invested more in technology to automate repetitive tasks and have increased their focus on mentorship and mental wellness resources. While the job remains one of the most demanding, these changes reflect a growing awareness of the need for a more sustainable work environment. Ultimately, the lifestyle of a junior investment banker is one of intense, front-loaded sacrifice. The prevailing mindset is that an analyst is making a 2 to 3 year commitment to a career accelerator in exchange for an almost singular focus on their work. They receive a deep immersion in corporate finance, a powerful professional network, and significant financial rewards that can create a foundation for their future. It is a path that demands a tremendous amount of resilience, discipline, and a clear understanding of the trade-offs involved. Join us in Chapter 14 as we look to the future. After the analyst program, what comes next? We'll explore the typical career paths, from moving up the ladder within the bank to leveraging the experience in other prestigious fields like private equity and corporate strategy. Welcome back to a day in the life of a U.S. investment banker. We have explored the demanding, day-to-day reality of the analyst role. The question that naturally follows is, what is it all for? The intense 2 to 3 year analyst program is not just a job. It is intentionally designed as a career accelerator. For those who complete it, a significant fork in the road appears, presenting a wide range of highly sought-after opportunities. This chapter explores the most common career paths that open up after the analyst years. It is essential to state our disclaimer. This information is a generalized overview of common career trajectories in the financial industry. It is for educational purposes only and should not be interpreted as career advice, a recommendation, or a guarantee of any specific employment outcome. Individual career paths are highly personal and can vary widely. For many analysts, the first path to consider is continuing within the investment bank itself. An analyst who has performed well is often offered a promotion to the role of an investment banking associate. This is a significant step up. While the hours can still be long, the nature of the work begins to change. An associate takes on more managerial responsibility, directly overseeing the work of the analysts. They spend less time on the minute details of model building and more time on project management, client communication, and crafting the overall narrative of a deal. The focus shifts from doing the work to managing the work and the client relationship. This is the first step on the long-term path towards senior leadership roles like vice president and managing director. However, a majority of analysts view the program as a stepping stone to other opportunities. The rigorous training and exposure to high-stakes transactions make them highly attractive candidates for other prestigious sectors of the finance world, particularly on what is known as the buy side. Perhaps the most common and coveted exit opportunity is a move to private equity, or PE. A private equity firm uses capital from investors to acquire private companies, or take public companies private. After acquiring a company, the PE firm works to improve its operations and profitability over a number of years before eventually selling it. Former investment banking analysts are highly valued in this field because their core skills, financial modeling, valuation, and transaction execution, are directly transferable. The role of a private equity associate is similar in its analytical rigor, but different in its mindset. Instead of advising a client, they are now the principal, making the actual investment decisions and taking an active role in managing the companies they own. Another popular path is to a hedge fund. Hedge funds are investment pools that use a wide variety of complex strategies to invest in the public markets, such as stocks and bonds. The skill set required can vary, but the deep analytical training of a banking analyst is a strong foundation. The work often involves analyzing public companies, building financial models to predict their performance, and developing investment theses, all with the goal of generating returns for the fund's investors. The pace is often just as fast as banking, but it is driven by the constant rhythm of the public markets. For those with an interest in innovation and early-stage companies, venture capital, or VC, is an appealing option. Venture capital firms invest in startups and young, high-growth businesses. The work is less about complex financial modeling, and more about understanding new technologies, assessing business models, and evaluating the strength of founding teams. It requires a blend of financial acumen and a qualitative understanding of market potential. Finally, many analysts choose to move outside of the traditional finance industry altogether into corporate development or corporate strategy roles at large, established companies. A corporate development team functions like an in-house M&A group, responsible for identifying and executing acquisitions and partnerships for the parent company. This role offers a much better work-life balance while still allowing them to utilize their deal-making skills. It provides a unique perspective, allowing them to see how strategic transactions are integrated into the long-term growth of a single organization. The analyst program is a crucible that forges a powerful and versatile set of skills. Whether an individual chooses to climb the ladder at the bank or pivot to the buy side or a corporate role, the experience serves as a robust foundation for a career at the highest levels of business and finance. Join us for our final chapter, Chapter 15, as we conclude our series with a look back. We will summarize the key takeaways of a day in the life and offer some final thoughts on the enduring role of investment banking in the global economy. Welcome to the final chapter of our series, A Day in the Life of a U.S. Investment Banker. Over the last 14 chapters, we have followed our analyst, Alex, through a composite day. A journey that spanned the pre-dawn darkness, the adrenaline of a live deal, the meticulous work of an IPO, and the quiet intensity of the late-night grind. We've explored the culture, the lifestyle, and the career paths that define this demanding profession. In this concluding chapter, we will step back and reflect on the key takeaways and the fundamental role that investment banking plays in the broader economy. Our series began with a simple goal: to demystify the daily reality of a junior investment banker. We saw that the job is far more than a collection of headlines. It is a foundation built on relentless detail. It is hours spent in Excel and PowerPoint, ensuring every number is precise and every slide tells a clear, compelling story. We learned that the analyst is the engine of the deal team, providing the foundational work that allows senior bankers to provide high-level strategic advice. We witnessed the sheer variety of the work. One day is a deep dive into mergers and acquisitions, analyzing the strategic fit of two companies. The next is a pivot to capital markets, helping a promising startup prepare for its initial public offering. We saw that beyond the famous live deals, there is a constant stream of essential work: building pitchbooks to win new business, performing continuous market research, and participating in ongoing training to keep skills sharp. We also explored the human element. We saw that success is not just about technical skill, but also about communication, resilience, and an unwavering commitment to teamwork. The hierarchy is clear, but the execution is collaborative. The pressure is immense, but it forges powerful bonds and an unparalleled sense of shared accomplishment, especially on deal day, when months of confidential work become a public reality. Finally, we must consider the why. Why does this profession exist, and what function does it serve? At its core, investment banking is a critical intermediary in the engine of capitalism. Investment banks connect those who have capital with those who need it. They help growing companies raise the funds necessary to innovate, build new factories, and create jobs. They advise companies on strategic transactions, mergers and acquisitions, that can create stronger, more efficient, and more competitive enterprises. By facilitating the flow of capital and advising on major corporate decisions, they play a vital role in driving economic growth and innovation. The analyst's journey is a microcosm of this larger purpose. It is an intense, demanding, and transformative experience. It is a crucible that takes in raw talent and, through immense pressure and repetition, forges a highly skilled professional with a deep understanding of the mechanics of corporate finance. While the sacrifices are significant, the learning is unparalleled. Thank you for joining us on this in-depth exploration. We hope this series has provided a balanced, realistic, and insightful view into the demanding and consequential world of a U.S. investment banker.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.